Hey guys, how's it going? I'm Lewis Harding Investor and welcome back to my channel. And in today's video, I'm going to be analysing BP's stock. I'm going to be using fundamental analysis to see if the business is worth buying or not. I'll be then using a DCF valuation to determine the fair value of their stock. Let's get straight into it. So who are BP? So BP plc, formerly known as a British Petroleum Company plc, is a British multinational oil and gas company headquartered in London, England, and it is one of the world's 7 oil and gas supermajors. It is a vertically integrated company operating in all areas of oil and gas. So exploration, production, refining, distribution, everything from high stream, low stream, midstream, it does it all. It also has renewable energy now with biofuels, wind power, smart grid and solar. The company has operations in 80 countries worldwide and it produced around 3.7 million barrels per day back in 2018. So the company itself has a primary listing on the London Stock Exchange and it is a constituent of the FTSE 100 index. Now let's have a look at the sales summary for BP, and yeah, as you can see from 2020 to 2019, very drastic, and one word comes to mind: pandemic. But we'll start with downstream, upstream and other businesses and corporate. So in 2020, 90% of their sales came from downstream, and in 2019 it was very similar. And then the rest is made up of upstream, which makes up 10%, and yeah, the rest of it, it's not even worth talking about, let's be totally honest. It's very minuscule, isn't it? Sales per region though, and the non-United States part makes up 46%, the US makes up 31%, and then the UK makes up 24%. Now let's have a look at the income statement, and all of this data has been taken from Macro Trends and it is in US dollars. So from 2016 to 2020, the revenue's actually gone down. Yeah, not great. You can tell the pandemic has affected the company a lot. If you take out 2020, the revenue was, the trend was generally up. 2018 was a bit higher than 2019, but the trajectory was being higher. But 2020, not great. But then yeah, pre-tax income, wow, that's a big loss, isn't it? Income after taxes, it's like $20.7 billion. That is a lot. At least we can reclaim some of the losses as a tax rebate, but that is a big loss, isn't it? Now let's have a look at the balance sheet, and yeah, the two figures I look at on here, just as a first glance. Long-term debt, so from 2020 to 2016, it has increased by $12 billion, so quite a lot. Yeah, so returned earnings as well, it's the next figure we look at. Yeah, this has gone down massively due to that big loss in 2020. Right, onto the cash flow statement, and we'll start with cash flow from operating activities, and this is up, which is fantastic stuff. But yeah, free cash flow, it is up from 5 years ago, but it's not great, is it really, when you look into it? It's down from 2019, and hopefully going forward it can be positive free cash flow. We will have to see. I also like to have a look at what dividends have been paid, because I want to see these increasing over time. And yes, we have been increasing over time. A little bit of a concern that even though they made a loss in 2020, they're still paying out dividends. Not something I like to see, and that is a massive red flag. It doesn't matter what business you're in. BP pay a big dividend to keep people interested in their stock, but if your business has lost £20 billion in a year, you can't pay a dividend that year, I'm sorry. It's just unresponsible. So yeah, that's a massive red flag. That's just something I do look out for. Now onto the key financial ratios, and yeah, the current ratio is pretty solid, above 1, and the long-term debt to equity / capital is below my 50%. Yeah, if the business has, variety in the profit over the years, they can't have much debt, because if they have a few bad years with no profit, they'll struggle to get that debt financed. So yeah, it does make sense really when you think about it. The margins are not very good, low gross margins, low net margins. It's very similar across the oil industry. Yeah, return on equity, not great last year, and pretty poor across the board really. Not good really, let's be honest. Now onto the genuine impact stats for BP, and we'll start with the quality metrics. And yes, very low, like we've just seen with the figures, not entirely impressive numbers wise. Low profitability, weak financial strength and poor capital allocation. Not a great sign. Then looking on the value side, it's looking very, very cheap, and you'll see that rank of 160. So in the universe of genuine impact stocks, these guys rank 160 on the cheap scale. So it shows that, very cheap it seems based on the numbers, the price compared to the financials. Yeah, everything's looking very cheap. Let's have a look at the growth metrics, and it's across the board a bit off, isn't it? Revenue and earnings per share down, very low. Dividends per share up. So, and free cash flow to equity is medium as well. Something to point out, like I said last time, so dividends per share is high, so they're increasing for dividends, but the revenue and profits are, going down. Red flag. It's a big red flag, let's be honest. Now let's have a look at my analysis checklist for BP, and BP, it's in the UK, listed on the FTSE 100. A PE ratio of 14, so relatively low compared to the market right now. First pillar, so gross profit margin, not great, 16%, 15.6%. Net profit margin, minus 1% over the past 5 years, averaged out. Pandemic will have affected this massively, but still not good. Return on equity, low as well, not happy with that. But yeah, like we said before, long-term debt to equity and current ratio, solid, not too bad at all. Proven ability to grow, so revenue and net income growth has not grown in the past 5 years. Shareholder equity growth has been smashed a bit as well. Thankfully, free cash flow is up, and you'd want to see why is there a disconnect between free cash flow and net income, because over time these figures should be very similar. Great capital allocation, so yes, they have issued a fair bit of debt. Not good at all really. Dividend has grown as well. You're gonna hate me for this video. Dividend growth is up, but debt is up and the profit's down. They're basically borrowing money to pay dividends, and that is the ultimate red flag in my opinion. But anyway, away from the dividends tangent, decreasing shares have increased the shares slightly. Good acquisitions, I've given the benefit of the doubt. In the renewable sector, they're all over it. All over different businesses, so I'll give them a tick for that one. But yeah, we come to buy at a fair price, and on the valuation metrics, so on an earnings and a free cash flow basis, it's looking very cheap, especially on the free cash flow basis. Anything below 10 for price of free cash flow is considered very good. And yeah, a DCF valuation, so 10% return is showing a share price of £5.91, with an upside of 72%. So yeah, interesting stuff. Yeah, let's have a look at the figures from a DCF and see how I got to that figure of £5.91. Now let's have a look at my DCF valuation for BP, and yeah, the free cash flow estimates have come from Market Screener as always, and yeah, so the free cash flow is expected to increase a fair bit over the next few years. Clearly we're expecting oil prices to stay high for a bit. For a required rate of return of 10%. Fair value of the company of £5.91. So yeah, from here, valuation wise, it's looking good, isn't it? Questionable if it makes a good investment or not, but clearly from a value standpoint, it may well be. Who knows? So what are my thoughts on BP? So overall, I think BP is clearly looking cheap on a value and a free cash flow basis, but ultimately I just think it's not a good quality business. I think there's better places to put your hard-earned money. You work hard for your money, you'll be either working at a job, or you'll have your own business and you'll be wanting to invest some of your money into some stocks. I don't think BP is going to get you to your goals, unfortunately. It may be cheap on valuation metrics and free cash flow metrics, but I just don't think it's that good. Like, you've just seen that the revenue growth, it's been smashed by the pandemic. Going into the future, this might be completely different. It might be absolutely fantastic. High oil prices may mean it does really, really well, but there's quite a bit of debt there for an oil company, in my opinion. The return on equity isn't there, and the margins aren't there. And I'm going to say it once more, but in 2020, they made a massive 20 billion loss. But then they decided to increase their dividend. So you got to think, where does that money come from? You make a 20 billion loss, that's got to be paid for. So that's been financed by debt and probably some shares. So what else have they done? Well, they've probably borrowed money to pay the dividend, and that's just the ultimate red flag for a business. If you should just cut your dividend, it wouldn't be popular for the stock price, but it'd be better for the business in the long run. So that's what they should have done, and that's short-termism from management. So yeah, not great. You could probably tell I'm not a big fan. There's probably better places to put your money, and probably better oil stocks to own as well, in the midstream section, or other oil companies, just not BP. But that's just my opinion. Don't listen to me. Do your own research. I'm not a financial advisor, of course. I read my disclaimer. These are just my opinions. I'm just an idiot making videos on YouTube. As always, if you enjoyed today's video, please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos